Alright everybody, welcome back. Today we're going to be discussing what a put option is. Now in previous videos we discussed call options. Today we're going to be discussing put options. Here on the screen we have just a typical layout of options chains. You get your call options on the left, put options on your right. So for this video, since we'll be focusing just on put options, we'll close out the call options. And here we have just the put options. Now the stock we're viewing today is SNDL. It is Sundial Growers. You could look into the company if you'd like, but it is a company I've been selling options on, both on the call side and the put side, depending on the situation. So with put options, it's basically the opposite of a call option. It gives the person that buys the put option the right to sell the seller of the option stock at a given price before a given day. So as opposed to being able to buy the stock from a person, as with a call option, with the put option, it gives somebody the right to sell the stock to the seller of the put option. So with this here, we're going to show you, the options you have with the options, pun intended, to how to use put options to make money. So you can use put options a few different ways to make money. You can use it one way to make money if the stock is going down in price and you don't have the ability to short a stock, or you do not want to short a stock. What you can do is you can buy a put option, and so put option has an inverse relation with the stock price. So as a stock price goes down, the value of the put options go up. So if you're looking, if you see the stock based on your analysis that the stock price is going to be going down in the near future, whatever time frame you're looking at, instead of shorting the stock, which you could also consider doing, is buying a put option, and that'll give you, the right to make money. As the stock price goes down, the put option will go up, and then you can sell the put option at the later point, or do something else with it. Other ways you can use put options is selling. What we're going to do here today is selling a cash secured put, and that's basically where you can be the seller of the put option, and then therefore get a premium for selling that option. And all you have to do is put up the cash to secure it. So each contract is worth 100 shares. So if looking here at the 150 strike price, which is the one we're going to be doing today, this strike price, you times it by 100, because you got 100 shares per contract. So it's $150 worth of collateral you would need to sell this contract. So $150 is going to give you, again, multiply the premium by 100, because this is a per share price. So times by 100, so you're getting $15 per contract for putting up $150 collateral. Now this option expires on Friday, which is currently 4 days away from the filming of this video. So it's a 10% return in a week, which is why I've been trading a lot of options on this stock. So it's definitely a way that you can generate money. So if the stock stays above 150 at the end of the day on Friday when the markets close, the options will expire, and then you can continue doing it, week after week, or whatever your time frame is, month after month. I mean, there's tons of options available. I mean, you could sell it all the way out, to April, 32 days away. So you could sell it for 35 cents a contract. But I prefer to sell them in the weekly, or every 2 weeks out, depending. I mean, see, just to compare prices really quick. I mean, you're only getting 5 more cents per share to extend an additional 7 days. So to me, that's not really worth it. I'd rather just sell it every single week and just get the most for the money. I mean, you could look into whatever time frame you want, but today's just a very basic analysis of what we're doing here. So we're going to be selling the put options here. I'm only going to sell 2 contracts because that's all I'm going to do at this time. So I always sell them at the bid. I don't typically wait around for it at the ask. I mean, you can sit around at the ask. I mean, it's up to you. But for this stock, I just typically don't do that. I mean, you can see the ask size right now is currently almost 12,000 contracts, for sale at the 20 cents there. I mean, so you'd have to go through almost 12,000 contracts to even have a chance of getting sold. So for me, that's really just not worth it. There's 1,400 sitting at the bid, or now 1,500. It's just not worth the wait for an extra 5 cents per share, which would be $5 per contract. But I mean, I'm happy with getting the 15, and that's how I always look at it. So here we're entering in the contract, selling two of them for the March ones. $1.50 strike price, limit price 15. Always do limits. Don't ever do market orders. So preview. After the fees, whatever, you get 28.97. So we'll send it and we'll see if we get filled. Sometimes we get filled above 15 cents. So let's go ahead and see. Okay, so yep, we actually got filled at 16 cents. So we actually made an additional $1 per contract than we originally thought, which is good. So obviously that generated more cash for us. Now these contracts will expire at the end of the day on Friday. What I will do if it expires, if the price of the stock stays above 150, is I'll probably look into selling these again next week. I'm looking to just build up a little bit of cash in my account so I can make a stock purchase, but I just want to build up the cash first, which is why I'm doing this. If the stock ends up going below 150 and I get assigned the shares, what I'll then do is for the next week is I'll just go ahead and start selling the 150 covered calls on it. Now you might wonder why I would sell the 150 calls if I bought it at 150. Well, technically I'm going to be buying it at $1.35 a share because we got the 15 cents per share after the fees. So we're really buying it at $1.35 if it goes below $1.50. So that would be my break even at $1.35. And then when I sell the $1.50 call, if for some reason this does go below 150, I will then also get the premium for selling the call options. I mean, right now it's 20 cents for this week. So I mean, you would have to imagine if it's as long as the price is somewhat similar to what it's at now, you're probably going to see a call option around that same price. So I mean, if it's below 150, you might end up getting like 15 cents as well. But then again, you're lowering your cost basis again by another 15 cents. So if I do sell the call option at 15 cents, now the cost of the shares are $1.20 per share. So, I mean, you're just generating, cash each time you sell the option, and then also lowering, your break-even point. So as long as, currently the way the trade is right now, as long as the stock stays above $1.35, make money. If it does go into next week and the shares get assigned to me and then I have to sell the call option and I sell it at say 15 cents again, then my break even is $1.20. So, not only are we getting cash every time we're selling these options, we're also lowering our break even point. So it's making it a higher chance for profit. So that is, basically what I use put options for. There are definitely tons and tons of other strategies when it comes to put options, and we'll get more into them. I do lots of different kinds of options trading. I do spreads, I do iron condors. I mean, I do just covered calls. I do buy puts and calls sometimes, but not that much. Probably, I guess what you would call, part of the theta gang. Definitely, looking for the theta, and you'll see that in my other videos coming up. We'll be discussing what the Greeks are, and more specifically theta and why I gravitate towards theta is what I look for. As you can see here, this one has the highest theta for the contract I just traded. Out of all of these strike prices for the ones that expire Friday, has the highest theta. And you'll see that in a future video of what theta is and why I go for it. But hopefully that gives you just a basic concept of what a put option is and how you can use a put option to make money and generate cash every single week. If you keep selling these put options every single week, you get a 10% return every single week by using $150, and you're getting $15 for it every single week, and you just calculate out annualized return. I mean, you're making quite a bit of money. I mean, you have the ability to sell 15, 20, 25 contracts a week. I mean, you're starting to get some real serious money. I mean, it's definitely all relative to what you have. I mean, 10% of a return for 1 week is good no matter what. So hopefully got that information from this video today, and we'll definitely have a lot more information. If there's anything specifically you're looking for when it comes to options or other stocks investing, definitely leave it in the comments below, and we'll definitely make a video on that. But until next time, guys, we'll see you.